In 1988, Warren Buffett bet over $1 billion on a single stock, Coca-Cola. Wall Street thought he had lost his mind. The stock looked expensive by every normal measure, but Buffett wasn't looking at the price. He was looking at one number nobody else calculated, intrinsic value, and by the end of this video, you'll know how to calculate it yourself. This is the idea that made Buffett the richest investor. A stock is not a ticker that wiggles on a screen. A stock, like Coca-Cola, is a piece of a business. And a business, Graham said, is worth one thing: all the cash it will hand you over its life. That sentence is the whole game. Read it again. Intrinsic value is every dollar Coca-Cola hands back from today until the day it closes its doors. Add up that future cash in today's money and you have what the business is truly worth. The price tag in the market is just an opinion. The intrinsic value is the fact underneath it. In 1988, the crowd only stared at Coca-Cola's price. Buffett invests by measuring the fact. So, how do you actually measure it? 3 steps. Step 1, estimate the cash the business throws off, not the accounting profit, the real owner's cash. Buffett calls it owner earnings. Here's the recipe. Start with Coca-Cola's net profit for the year 1988. Add back depreciation, a paper cost, not real cash. Then subtract the money it must spend to stay alive. New equipment, maintenance, the cost of just surviving. What's left is the cash an owner could pocket. Owner earnings, near $1 billion at Coca-Cola, is the engine. For Coca-Cola in 1988, that engine was enormous. It earned huge cash and barely spent to keep going. Why? Because of the second thing Buffett checks: the moat, the durable edge that protects the cash. Anyone can sell brown, fizzy sugar water. Almost nobody can sell it as Coca-Cola. A century of trust priced into one red label. That brand let Coca-Cola raise prices for decades. A moat means the cash keeps coming and grows. No moat and competitors drain the cash away. So step 1 gives you Coca-Cola's cash this year. Step 2, project that cash into the future. Buffett needed no crystal ball, only a range. Ask, can this business earn more in 10 years? For Coca-Cola, the answer was obviously yes. Billions of people more every year drinking it. A growing river of cash year after year. Graham warned, assume slower growth than you hope. If it still looks cheap, you have a margin. Now step 3, the part most people skip. $1 in 10 years isn't worth $1 today. The moat. Coca-Cola's durable edge that protects cash. So future cash must be discounted back to now. That's called discounting. It sounds scary, it isn't. Graham's rules shrink each future year a little. Coca-Cola's brand let it raise prices for decades. Add all those shrunk dollars together. That sum for Coca-Cola towered over its 1988 price. You just did a discounted cash flow in your head. Now compare it to the market price. If Coca-Cola's value beats its price, you buy. If price is above value, you walk away. Simple, but here is the secret weapon. Never buy at intrinsic value. Demand a discount? Graham called it the margin of safety. Buy $1 of value for 50 cents. Why? Because your estimate could be wrong. Say a Coca-Cola-like business earns 10 owner dollars. It's the difference between investing and gambling. Let's do it with real numbers, slowly. Say a business earns $10 of owner cash. Year 3, nearly 12. Coca-Cola's cash kept climbing. In year 1, $10. Year 2, almost 11. Year 3, nearly 12. The cash keeps climbing. Project 10 years. As Buffett did for Coca-Cola. Now shrink each year back to today's money. Use about 10% as your shrink rate. Year 10's cash counts for less than half now. Add Coca-Cola's shrunk years, then the years beyond. Coca-Cola's value towered near 150 per share. For a business earning just 10 today, that gap is why Coca-Cola's growing cash was precious. Like Graham, demand a margin. Halve that value. You'd only buy near 75, not 150. Buffett bought low, then waited with patience. That discipline made Buffett rich, not the crowd. Now the traps that ruin beginners. 3 of them. Trap 1, trusting a single precise number. Even Buffett used a fuzzy range, never a sharp point. Buffett never used a spreadsheet to 12 decimals. Trap 2, assuming Coca-Cola-like growth lasts forever. Even Coca-Cola slowed down. Graham planned for that. Trap 3, falling in love with the story. A great story with no cash fooled Wall Street. Always drag yourself back to the cash. Avoid those three and you beat most professionals, because the pros chase price. You measure value. Now back to Coca-Cola and what Buffett actually saw. In 1988, Coca-Cola traded near 15 times earnings. Expensive, said the crowd. Cheap, said the cash. Buffett saw a growing, unstoppable river of profit. Discounted back, the business was worth far more, so he bought over $1 billion of it and he didn't trade it, he held. Second, find Coca-Cola's owner earnings for the year. Buffett's cash river kept rising exactly as judged. That billion-dollar bet became worth many billions. Not from a hot tip, from one calculation. Now let's do what Buffett did, step by step. First, find a business you genuinely understand. If you can't explain how it makes money, skip it. Second, find this year's owner earnings. Lean conservative, the way Graham always taught. Third, ask if that cash can grow and how safely. Lean conservative, boring assumptions make rich investors. Fourth, discount the future cash back to today. Fifth, only buy with a fat margin of safety. Those 5 steps are the entire Buffett engine. Notice what is missing from the whole method. No predicting next week's price, no charts, no noise. Even Buffett's shares were called dead money. The market will scream at you to do otherwise. Graham's students were mocked for boring stocks. Let it scream, you did the calculation. Value is a fact, as Buffett proved with Coca-Cola. Moods change daily. Facts compound for decades. This is why patience, not genius, builds fortunes. Buffett didn't have faster computers than Wall Street. Buffett had a simpler question. What is Coca-Cola worth? Moods change daily. Coca-Cola's cash compounded for decades. It might take a year, it might take 10, but value pulls price toward it like gravity. So practice on one company, maybe Coca-Cola this week. Pull Coca-Cola's annual report. Find owner earnings. Sketch its future cash on a single napkin. Discount it, demand half off, then decide. Do that like Buffett 10 times and you'll see clearly. Most of the market never learns to see this way. That blindness, Buffett said, is your advantage. You don't need to be right about everything. You need to be roughly right with a margin. And then, like Buffett in 1988, you wait. That's it. That's the calculation worth $1 billion. Intrinsic value, the cash discounted with a margin. Buffett built an empire on that one sentence. Now you have it too. Use it. Remember the order. Cash first, then growth, then discount. Then the margin of safety on top of everything. Master that sequence and price stops scaring you. You'll see green where the crowd sees red. Subscribe so the next lesson, balance sheets, finds you. In 1988, Buffett did this math on Coca-Cola. He found $1 of value selling for 50 cents, so he bet over $1 billion and waited. That billion in Coca-Cola became more than 10 billion. Not from luck, from the calculation you now know.